Welcome, everyone. Thank you for joining us today. My name is Mark Bautis. On today's webinar, we're going to talk about some insights and information I've learned about retirement income planning. If you're here, it probably means you're thinking ahead to retirement and wondering how you're going to be able to replace the income you'll need to meet your expenses after those paychecks stop coming in. You've spent years saving and probably have amassed a good-sized piggy bank, maybe even a couple of piggy banks. Yet there's still that worry that your savings and investments, they're not enough to support you through those golden years. So over the next 45 minutes, we'll talk about how you can manage those piggy banks to generate the retirement income you'll need. I'll walk you through some of the basic guidelines to building a retirement income plan, and I'll be happy to take your questions. I have my colleague, Kira Mackesy, on. She'll be monitoring the chat and Q&A boards for any questions. At the end, we'll go through them. She's also going to drop a link in the chat for anyone who wants to schedule a free consultation with me. And that's if you have any specific questions to your situation that you'd like to discuss. The workshop is titled Life After Work because retirement income planning really is about creating a good life for yourself after you leave your primary job. It doesn't mean that you won't necessarily work. In fact, many boomers are planning to continue working in some capacity after they leave their main job. But hopefully the work you do in retirement won't feel like work. Work's the thing you're getting away from. Life is what you're moving towards. Now, like anything else you buy or invest in, you need to figure out how to fund your life after work. You need a budget and a plan. For many of us, we're talking about 30 years where you'll be responsible for your own paycheck. So given the length of time that we're looking at, you need to have a retirement income plan. And if there ever was a time to plan, retirement is that time. So once you leave your primary occupation, you start depending on multiple sources of income in retirement, you want to make sure that that income lasts. No one wants to go back to work at age 80 because they didn't plan right. So it's really important to have a plan. And the retirement income plan helps you determine how much income you'll need, where that income will come from, when you'll start collecting Social Security, whether or not you'll work, and how to manage withdrawals from your retirement and investment accounts in order to have a sustainable lifestyle throughout retirement. And above all, we want to make sure that your income outlasts your last breath of air. So we need a plan to manage your retirement savings over what could be a 30-year time period, and maybe even more. You could live to 100 plus years. And the problem with living that long is, will you have enough money? Or how is your retirement planning measuring up? So recent research has shown that people are more confident that they'll experience a comfortable retirement, reflecting the general improvement in the economy. And if you play your cards right, you'll be able to retire with confidence and not worry about your income sources dying out. In this 2019 Retirement Confidence Survey, you can see what pre-retirees expect in terms of major and minor income sources compared to the actual income sources in retirement. These income sources include Social Security, employment earnings, investments, and pension plans. So for example, Social Security is an expected major source of income for 36% of the workers who haven't reached retirement yet, and an actual major source of income for over 65% of retirees. So Social Security tends to play a bigger role in retirement income than many people realize before they retire. Then 74% of people expect to work and earn income at least on a part-time basis after retiring. However, only 25% of retirees actually add work earnings to their retirement income. Sometimes expectations don't match the reality of your finances post-retirement. So it's crucial to create and follow a detailed retirement strategy that leaves little up to chance. Many times, this is done with the help of a good financial advisor who has the resources, knowledge, and technology to analyze your current financial situation and organize a roadmap of financial plan modeling your cash flow through retirement. All right, so the next couple of slides paint a bleak picture of the current retirement savings in our country. Despite the fact that most people will need to rely on retirement savings in retirement, only 25% of American workers so there are 25% of American workers that have no retirement savings. And the numbers saving in IRAs are similar. Only 26% of American households have IRAs. Now, one of the benefits of being older is that we can save more money tax deferred. So for example, for a worker age 50 and over who has an IRA, only 16% have made catch-up contributions or the additional $1,000 contribution that they're able to make when they turn 50. That means you can contribute up to $7,000 this year, the $6,000 standard limit plus the $1,000 catch-up. So do you think your retirement savings are on track? Less than half of those age 60 or older perceive their retirement savings as being on track. For people age 50 to 59, it's 46%. And only 14% of American households have $250,000 or more saved for retirement. And in many cases, that's not going to be enough. So given all those stats, are you feeling more or maybe less prepared for retirement? Well, that's what we're here for today, to make you feel more prepared and show you what you need to do to get ready for retirement. And one of the first things to do, which will guide a lot of your other decisions, is to imagine your life in retirement. We need to take a step back, visualize how you want to live your new life. How will things be different after you leave your current job? How do you want your life to be? Where will you live? What will you do? How long do you think you will live? What surprises does life hold? How much can you visualize how much income you'll need? For some pre-retirees, the first consideration is where they'll live. Now, not everyone changes their residence in retirement, but a lot of people do. And if you're not tied to a job, you can be free to live anywhere. Perhaps you'd like to live closer to children or grandchildren. Maybe you'd like to downsize so that affordability will be a key consideration. If you plan to work or run a business, you'll want to think about the areas for the right employment or business opportunities. If you plan on doing a lot of travel, you may want to live next to a major airport. And then there's those usual general preferences, such as climate, culture, and recreational opportunities. Where you end up living, it'll have an impact on your retirement budget. So this is one of the first questions you'll want to consider. And up on the slide here, I've included some information from a recent poll from the Transamerica Center for Retirement Studies. And sometimes looking at what other people are doing, it can help you make decisions on what's important to you. So as a pre-retiree, are you considering downsizing? Now, a lot of Americans' net worth is tied up in home equity. This home equity is generally non-income producing and it's illiquid. But with downsizing, or there's other ways that you can tap that home equity, you can, whether it's a reverse mortgage, or maybe you do look at that decision to downsize or potentially rent. It may unlock a substantial portion of your net worth to help support your standard of living in retirement. Studies show that the home values since 1900 have grown an average of 3.1% per year. So for some folks, it may be better to invest your money elsewhere. And like I said, tap some of that home equity that you built up. If you continue to own, you should consider right-sizing your home, which may mean potentially downsizing the 4-bedroom, 3-bathroom home you currently live in to maybe a 2-bedroom, 2-bath home that may be more appropriate and less costly to maintain. Or maybe you need a bigger house. I don't know, but you and your spouse and family need to think through some of these issues and determine what you'll need in retirement. If you're not working anymore, how will you fill your time? From a financial perspective, daily activities fall into one of two categories: income generating activities and expense generating activities. If you work or run a profitable business, you'll be generating income from your daily activities. On the other hand, if you're not working, you'll need to fill in your time doing something. Unless you plan to take walks and read library books all day, you may end up spending money on travel, hobbies, and entertainment. And there's nothing wrong with this, but you'll just have to factor in that those are expenses and just make sure they fit into the budget. And of course, if you plan on starting a new business, don't forget that it may not be profitable at first. So count your business startup activities as an expense generating activity until it becomes profitable, and then you can obviously see how that fits into your budget. People can spend as much money in retirement as when they worked. An industry rule of thumb is to expect to spend 70% as much per year in retirement as you did while working. And obviously it's not a straight line. What I see a lot is when people do retire, their spending actually does go up a little bit, only to transition downward as they get older and maybe less mobile, or they're doing less of some of these activities that we're talking about. All right, so the next thing to consider is how long will you live? And if we knew the answer to that question, retirement planning would be easy because your life expectancy will determine how long your money needs to last. Unfortunately, the way we plan is we have to plan for the worst case scenario, which means assuming you'll live to 95 or 100 or beyond. The average life expectancy in North America is 81 years old. But for a female, if you made it to age 65, there's a 53% chance that you'll live to 85 and a 32% chance that you'll live to age 90. For a couple, there's a 72% chance one of the spouses will live to 85 and a 45% chance one of the spouses will live to 90. Of course, if we die before then, it means we could have lived it up a little more, spent a little more, but what if we don't? Having some left at the end, life left at the end of your money means your retirement plan failed. But you won't know that until it's too late. So don't rely on the average life expectancy for your retirement income plan. Be safe, assume you'll live to 90, 95, 100. Unexpected events can derail the best laid plans for a successful retirement. Of course, if you knew what surprises life held in store for you, they wouldn't be surprises. But part of retirement income planning is taking a look at your life and the world around you and considering the unexpected. So health is a big issue for retirees. If you have Medicare and a supplemental policy, many of your healthcare expenses will be covered, except for premiums and some co-payments, of course. But the biggest concern, or one of the biggest concerns, is long-term care. Ironically, it's the healthiest people who are most likely to need it. If you live so long that your infirmities of natural aging prohibit you from performing activities of daily living, you'll need some kind of nursing care in your old age. And according to recent studies by Fidelity Investments, a retiring couple can expect that through the course of their retirement, they'll incur expenses, these are out-of-pocket expenses, of $250,000 for healthcare. Surprises can also come from family members, whether it's caring for aging parents or taking boomerang children back into the home. You may need to be prepared for the unexpected expenditures of time and or money. Plus, the economy always seems to be full of surprises. There's stock market fluctuations, which could cause your investment portfolio to decline in value. And there is truth to the theory that market declines hurt much more than gains help, especially when you're withdrawing from your portfolio. In addition, interest rate changes could decrease the value of your bonds. And inflation is always a big threat to retirees. We know that some economic forces cannot be predicted in advance, obviously. But that's why you have to be ready for anything that could come up. And when I say anything, it could mean floods, earthquakes, tsunamis, pandemics. So you just have to, and one of the things is you make sure your property and casualty insurance is paid up and you have your disaster kits in place. All right, so the big question is, how much income will you need in retirement? And the lazy answer is that about 70 to 80% of your current living expenses. That assumes you'll no longer be funding your retirement plans. You'll save on the expenses associated with working, such as transportation, meals out. Maybe there's some clothing expenses that you save. However, consider how you'll spend all that free time, and it will probably cost you money that you weren't spending while working. So the more accurate way to estimate your income needs is to set up a spending plan as if you were already retired. And this is where the answers to those questions come into play. So if you know where you'll be living or whether or not your mortgage will be paid off, you can more accurately estimate your housing cost in retirement. And you just want to do this for every category that's using today's dollars. I have a worksheet that can help you, or a tool that can help you with this budget, and we'll share a link in the resources to the webinar replay. But once you have an idea of how much you'll spend in your retirement years, especially those expenses in the initial years of retirement, then you can move on to the next source or next stage, which is identify how you're going to pay for this all. And it's time to start marshaling all those piggy banks you've accumulated in the efforts to pay for retirement. So one important piggy bank or income source for many people is Social Security. And if you and your spouse are eligible for Social Security, you need to consider how to claim Social Security to help maximize those expected benefits. Another piggy bank is pensions. If you're lucky to have one, you may need to make some elections, like whether or not there'll be a spousal or survivor benefits for your heirs in the event of your passing. If you have an annuity contract, perhaps it has a living benefit guarantee that may be able to provide income or guaranteed withdrawals. Perhaps you'll work part-time in retirement. Or do you own any investment property or have interest in a business that will generate income after you retire? So what's so different about retirement compared to working full-time in your primary occupation is that you have to manage all these income sources. No longer can you count on direct deposit of a paycheck that's high enough to meet all your income needs. And each of these income sources have different characteristics. And it's important to keep those characteristics in mind when you're arranging all of those piggybacks. So Social Security keeps up with inflation and it's guaranteed for life. Once it starts, you don't have to think about it very much, but deciding when to start, it's a major decision for pre-retirees. And we'll talk more about this in a minute. If you're one of the few lucky people still entitled to a pension, that income will also be guaranteed for life, but pensions generally are not adjusted for inflation. So as your expenses go up, you'll have to fill in that increase from somewhere else. Maybe you plan on working during retirement. Depending upon what work you'll be doing, or if you're starting your own business, your income will either be fixed or variable. And you want to keep in mind that this income will not last forever. At some point, you'll want to stop working for good. So you may want to stash some of that earnings into savings for when that day comes. And then there's investment income. This includes the withdrawals you take from your investment accounts, your retirement accounts, savings accounts, if you have rental properties, or any other assets that you own. And often this is the trickiest part of retirement income planning because that income, it may be fixed, it may be variable, it's often taxed, and you must actively manage it to make sure it lasts throughout your lifetime. So what will that retirement income look like? Here's what it looks like for the average retiree. The average retiree has about $48,000 a year. About $17,000 of that comes from Social Security, $7,000 from pensions, and about $3,300 comes from savings, dividends, and income from property. And another survey done by the Transamerica Center for Retirement Studies found that 61% of retirees rely on Social Security. Next up are pensions at 14%, and then followed by 10% relying on 401ks and IRAs. So let's take a look at each of these sources of income. Okay, most people like to start with Social Security because it's a predefined amount of income. Once you turn 62, your Social Security benefit is calculated based on your earnings history. Before you turn 62, the Social Security Administration estimates your benefit, assuming your present earnings will continue. To find out what your benefit estimate is, you can refer to your latest annual statement from the Social Security Administration or go online to their retirement estimator, which taps into that Social Security earnings database to estimate your benefit based off of your past earnings. Another common source of income for retirement is a pension. The big question here is not whether or not you'll get one. Most employers have abandoned their company-sponsored pension plans because they were costing too much. But if you're one of the lucky ones that still have one, you have some homework to do. You want to find out when are you entitled to your pension, how much will it be, and what your distribution options are. Sometimes it's better to take it as an annuity. Other times it's better to take it as a lump sum and roll it into an IRA so you can manage the investments. If you need help analyzing your pension distribution options, we can help with that. And by the way, we're not counting 401k plans as pensions. Strictly speaking, pensions generate monthly income for life, and the company assumes the longevity risk, which obviously if you opt for the lump sum, then you're taking that longevity risk on your side. 401k plans are more like investment accounts because you're putting your own money into them and you're responsible for choosing the investments and managing the withdrawals when that time comes. So if you have access to a pension from your employer or even former employer, you definitely want to consult with a financial professional before making any elections on that pension. You'll often have options such as a lump sum payment, a single life annuity, a joint life annuity, a partial survivor benefit, or a period certain. And your selection is generally irrevocable when it's made. So it's important to truly review all of your options. So for example, while selecting a single life annuity may provide the highest benefit, it will not provide income to your spouse or beneficiaries when you die. So the rules are a little tricky. You just want to make sure you review the fine print, review all the options, and discuss them and walk through the pros and cons of each one. Okay, so how about work? More and more people are planning to work during retirement. I suppose you could then question the word retirement for this time of life, but often the work takes on a different form. If you plan to keep working at your present job, you aren't really retiring. You're just delaying retirement. And that is a very good decision for many people. A few more years of work will add to your financial security, boost your savings, and shorten your drawdown period. So keep at it. If your work isn't terrible, you like what you're doing, and it brings in a good paycheck, maybe you work an extra year or two. But once you leave your main job, there's several work options available to you. Sometimes retirees become consultants, converting their former employers into clients and working according to their own schedule. Others launch a whole new career or business and throw themselves into the work even more than they were before. Still others start slowing down, working a little less in their primary occupation, or finding an easier job, maybe with lower stress. It's always better if work decisions can be made without regard to finances. So, after all, this is your chance to switch careers and do something you really enjoy. But after looking at your piggy banks, you may find that there's not enough income from those other sources, which means you're basing your work decisions on how much income it will generate. And with that, you want to remember what I mentioned earlier. You probably won't work, you probably don't want to work all the way to the end of your life. Although I do have some people that say, let's plan for that. At some point, you'll want to stop. Maybe you want to work fewer years at a higher income, even if it's work you don't enjoy very much at all. Or if you find work you really like that doesn't pay very much, it isn't too physically demanding, you'll be able to continue it for many years. These are all things to think about when putting together that retirement income plan. Okay, so another potential source of income in retirement is an annuity. An annuity is similar to a pension in that it can provide guaranteed income. However, it is funded through your own personal investments and not by your employer. So if you have an existing annuity, or you've been considering an annuity as a potential investment for income replacement, we'll talk a little bit about what your options are with that. An existing annuity may have living benefit riders or an annuitization option, which may be able to provide a guaranteed income stream or withdrawal benefit for the rest of your life. Annuities are generally complicated, expensive, and there's often penalties or withdrawal charges associated with the contracts. And while they do offer tax deferral, withdrawals are often taxed at ordinary income tax rates. So if you are considering an annuity as part of your retirement plan, look closely at the prospectus, and you definitely want to work with an advisor to explore all of your options you may have and the potential costs of each of them. All right, through our lives, we acquire a lot of different piggy banks that we stuff with money for different reasons. Some of these are retirement accounts like IRAs, Roth IRAs, 401ks. Some are non-retirement accounts like your checking, savings, CDs, and maybe just a regular investment account. All of these accounts are important because they represent piggy banks stuffed with your savings that will eventually fund your retirement. And finally, we have a small percentage of retirees who earn income from other sources, such as an investment in an income-producing property or interest in a business that will continue producing income after you retire. Often, this type of income is variable, but it definitely needs to be considered along with your other income sources. Okay, now once you've identified all the sources of income you can tap in retirement, you have a very challenging question in front of you, or it can be challenging depending upon your situation. And that is, how do you create an income stream from all these piggy banks, all of your retirement and investment accounts? You have to start integrating these income sources and spending the assets. What's the best way to spend your savings so that it lasts longer? Now, there are a couple of ways to draw down your assets in retirement. The classic approach is to live off the interest. Another formula is the so-called 4% rule. A third is to use a bucket approach. And the fourth is to invest to meet your different types of expenses. And those are usually bucketed into mandatory versus discretionary. There are more, and there's a lot of derivatives of these four, but these four give you a good idea of what you need to consider when funding your retirement. So for example, suppose you want to retire in your 60s, but you don't want to claim Social Security until age 70 to get the biggest benefit. Great, but how are you going to fund that gap? How are you going to pay for your expenses in retirement without the benefit of Social Security? Are you going to withdraw money from taxable accounts? Are you going to withdraw it from a tax-deferred account? At all times, you want to optimize your situation so that your money lasts as long as it can. So what we're going to do now is we'll review the four approaches to withdrawing assets that I mentioned, and we'll see how they may work for you. Okay, so living off the interest, it's the classic approach to retirement income. It's what your parents probably did. And the way this works is you invest in income-generating investments like bonds and dividend-paying stocks, and you spend only the income generated by those investments. You don't touch the principal. It used to be believed that once you dipped into the principal, you were doomed to run out of money. Then the high inflation years of the 1970s changed all that. People whose bonds were kicking off fixed income had a hard time meeting their expenses, which were going up every year with inflation. In any case, today's low interest environment makes it hard to live off the interest because it requires a lot of principal to generate decent income. For example, a high quality bond may generate 2 to 3% interest and carry interest rate risk in that the bond prices will likely lose value if interest rates go up. Dividend stocks are generating approximately 2.5% in dividends, and there are other investments that you may earn that may carry more risk. With low interest rates, $1 million portfolio may only earn $20,000 to $30,000 in income without taking additional risks. So there is a way to utilize this strategy today where you may need to take some of the growth with that, and you're still not tapping the principal, but just looking at the income it generates. It's a tough way to do it now with the way that the interest rate environment that we're currently in. Okay, the 4% rule, it's received a lot of attention because it's quick, it's easy to understand. Simply put, in your first year you take 4% out of your retirement investment accounts, and it doesn't matter how much your investments earn that year. If you start with $1 million, your first withdrawal is $40,000. This could come from interest, dividends, or capital gains. Then the next year, you increase that amount by the rate of inflation. So if inflation is 3%, your next year's withdrawal will be $41,200. Again, it doesn't matter how much the portfolio earns. On the day you retire, you set your withdrawal amount and increase it each year by the rate of inflation. This idea came from some studies done in the 1990s that reviewed every 30-year time period going back to 1926 and determined that if 50% of the assets were invested in stocks and 50% in bonds, the 4% withdrawal rate had a 0% chance of failure. So it's become somewhat of a standard for retirement income planning. However, it does have its critics. Some people say it doesn't let you spend enough. If the markets do very well, you're not allowed to take out more, so you end up leaving a lot to your children. I guess the kids would be happy about that. Other critics say that the time periods tested were the happy days of the US economy, and that going forward, the markets may not do so well. The withdrawal plan can be somewhat hard to stick to, since most people want to take out more when their investments are doing well and less when they're not. It's hard to take out the prescribed amount if your investments are down 10 or 20%. On the other hand, you may have to in order to meet your expenses, especially if costs increase due to inflation. With the bucket approach, you earmark different accounts for various needs and invest separately for each. One popular way to do this is to arrange the buckets by time horizon. Any money that you'll need within 5 years is placed in the first bucket and invested very conservatively so that there's no worry that your investments will decrease in value at the time that you need that money. So you basically figure out how much money you'll need over the next 5 years to meet living expenses and put that amount in the first bucket. Amounts over that are placed in the next 2 buckets, one for 5 to 10 years out and the other for more than 10 years out. As you draw down assets from the first bucket, you replenish them with withdrawals from the second bucket so that you always have 5 years worth of expenses in that first bucket. Because the second and third buckets have longer time horizons, you can invest them more aggressively for growth and or inflation protection. Maintaining 5 years of expenses in a more liquid and conservatively invested short-term bucket also will help you to not panic when the markets decline, as 5 years is longer than any bear market has lasted, with the average bear market lasting only 15 months. Another way to arrange your buckets is according to your goals. For example, you might put a certain amount of money into the vacation bucket, so you'll be sure to have that available when you're ready to take that world cruise. Another good bucket to have is your emergency fund in case the water heater breaks or the car needs major repairs. Some people add up all the money they're likely to need for healthcare expenses in retirement and put that in a separate bucket. And then the same thing for long-term care. Another formula is to cover your fixed expenses. Some people love the idea of knowing that their mandatory expenses will be covered no matter what. They don't mind cutting back on vacations as long as they know they'll be able to pay for rent, mortgage, utilities, food. So another approach to retirement income planning is to arrange for a guaranteed source of income like Social Security or a pension or guaranteed investment to pay for that mandatory expenses. And then you invest the assets that will be used for discretionary expenses like travel and entertainment vehicles that offer growth potential or inflation protection. So for example, if your mandatory monthly expenses are $5,000 and you're receiving $2,900 a month from your combined spousal Social Security benefits and $1,600 a month from your pension, you may secure an annuity to generate that additional $500 per month in income required for your mandatory expenses and invest the rest of the portfolio in more variable or income producing investments to generate enough cash flow to pay for things such as vacations, gifts to loved ones, and hobbies. As you can see, there are a number of different ways to arrange your buckets depending upon your situation. The best thing to do is sit down and talk about your retirement with me or another financial advisor and explore your options based on your goals and resources. Okay, so now let's look at the pros and cons of each approach. So first, we have living off the interest. It's very simple. You just invest in interest or dividend-paying securities and only spend the income thrown off by these investments. The downside is that in today's low-interest environment, you won't be drawing very much income. Like we mentioned, for example, $1 million portfolio, it may generate between $20,000 and $30,000 per year in income without taking on significant credit and market risk. Also, most fixed income investments don't offer inflation protection. So as your expenses rise in the years ahead, your income won't keep up. You might find yourself having to invade principal. One way around this is to start out with a sufficiently large amount that you don't need all the income for spending, so any excess can be reinvested for the future. But again, at today's low interest rates, it would require a rather large sum to generate the income you need. Mandatory versus discretionary. It's very comforting for a lot of people when your basic living expenses are guaranteed in some way. You can be assured of staying in your home, not starving. If times get tough and you're not able to take as many vacations as you like, it's a small price to pay in order to be assured that your basic expenses will be met. One difficulty with this approach is the complexity of the vehicles offering guaranteed income, not counting Social Securities and pensions. Some of these vehicles carry high fees, so you have to shop carefully. Also, the discretionary side will fluctuate in value. An advantage of the 4% rule is that it's predictable. You know from the outset how much income you can count on. And it has built-in inflation protection because it adjusts every year. Although the income itself is not dependent on investment results, the ultimate success or failure of the plan does depend on how the investments perform. You need to monitor the plan every year and adjust it, as you may end up with too much money in good market years, or you may be short in the year that the market experienced a loss. The bucket strategy has become a popular approach because it offers inflation protection, flexibility, and potentially more income. In the evolution of retirement income strategies, this is the latest iteration, but that doesn't mean it's easy to set up. It's more complex than it appears because you have to determine how much money goes into each bucket and then choose appropriate investments for each bucket. You have to watch the buckets to be sure that the investments are doing what they're supposed to be doing and that the money gets transferred from bucket to bucket at the right time and in the right amount. And again, success depends on investment results. As you can see, there's no perfect foolproof strategy for generating income out of investment and retirement accounts, but we can help you evaluate the pros and cons in light of your individual situation and help you implement and manage that plan on an ongoing basis. Taxes are an important element in your retirement income plan. We're not going to go into a great detail on taxes today, but you need to know some basics. Different types of income are treated differently when it comes to taxes. And unfortunately, you will still owe some money to Uncle Sam in retirement. So let's review what you need to know. Social Security benefits are tax-free unless you have other income and your other income is over a certain amount. In this case, up to 85% of your Social Security benefits may have to be reported as income. So notice I didn't say that your Social Security is taxed at an 85% rate. That would be a huge chunk in taxes. There is a formula that determines if your other income is high enough that 85% of your Social Security benefits would be subject to taxes at your marginal tax rate. One way to reduce or avoid this tax is to manage your other income so your total income falls below this threshold. Pension income is generally taxable unless some of it is being drawn from an after-tax account. If you elect to take your pension as an annuity rather than a lump sum, you want to ask your benefits coordinator to explain how it will be taxed. If you end up taking your pension distribution as a lump sum and you roll it into an IRA, you have some control over how it's taxed by deciding when to take distributions. This falls under asset income, which I'll get to in a minute. Okay, so you know how your income from work is taxed since you've been paying taxes on your earnings for all these years. Income from work is taxed as ordinary income. If you have enough of it, it could cause some of your Social Security benefits to be taxable as well. But the main thing to keep in mind about work is that the government never takes 100% of your money. And it always pays to work, even if you lose some of your income to taxes. So not working is not necessarily a good strategy for boosting your retirement income if you are able and willing to work. However, you may want to consider postponing Social Security or reducing your retirement plan withdrawals and savings, these resources for later. Sometimes it's better to just take as much income as you need and keep the rest protected from taxes. So we'll help you figure out how to do that. Investment income may be taxed in different ways depending on the type of account that these assets are in. If they're in a taxable investment account, you pay tax on investment income as it's earned, not when it's taken out for spending. For example, if you have an account that generates $30,000 in investment returns in 1 year, but you take out only $20,000 for spending, you'll pay tax on the full $30,000. But when you take out that other $10,000, you won't have to pay taxes on it because that money's already been taxed. In other words, taxation of a taxable account hinges on investment earnings, not your withdrawals. Conversely, if your money is in a tax-deferred retirement account, such as an IRA, the investment income is not taxed on the distribution you'll pay taxes on the distribution at your ordinary income tax rate. So if your IRA earns $30,000 in investment returns and you take out $20,000, you'll pay taxes on the $20,000. These are all important things to know when you're setting up your retirement income plan. Taxes play a huge role in determining the amount and timing of your withdrawals. And again, we can help you work, with your tax advisor to help you draw the income you need with the optimal tax result. Okay, what can you do to lower your taxes during retirement? First of all, consult a tax professional or financial advisor before you make any final decisions. Some of these decisions you can only make once, but some things you can think about include drawing down your IRA before age 71 in order to reduce your required minimum distributions the government forces you to take once you turn 72. Another thing to consider is converting your traditional IRA to a Roth. You'll have to pay tax on the money you move to a Roth IRA, but once your money is in the Roth, you can withdraw at any time without paying taxes, which means that a Roth IRA is one of the last accounts to touch in building your retirement stream. As we've previously mentioned, delaying the start of Social Security benefits until age 70 not only gets you a higher benefit, but it reduces the number of years you'll have to pay taxes on those benefits. And another way to reduce taxes is to work on the expense side of the equation. If you spend the time between now and age 72 paying off debts, downsizing, and generally reducing your living expenses, you'll be in position to make do with less income, so you can really keep your income low and will be subject to less tax. And don't forget that the tax management will continue after you turn 72. You'll need to manage any taxable investment accounts so that they don't throw off income that could bump your total income up into the next tax bracket. And a basic tenet of tax planning is to put off or defer paying taxes for as long as possible. By investing the money rather than turning it over immediately to Uncle Sam, you can earn returns that are yours to keep. For many people, the idea of tax deferral is so appealing. When the time comes to start spending their retirement income, they draw from taxable accounts first to keep tax deferred accounts growing for as long as possible. That may be appropriate for some, but not for everyone. In deciding which accounts to tap first, consider not just the account itself, whether it's taxable, tax deferred, or tax-free, but also the particular investments within each account. These investments, in turn, they relate to your risk tolerance, time horizon, and income needs. The downside of tax deferral, unfortunately, is that it can't go on forever. You must start taking required minimum distributions at age 72, and the larger the account, the larger the distributions and the tax will be. If the account is very large, the required distributions can throw you into higher tax brackets, forcing you to pay more tax than it did if you drew the account down earlier and paid some of the tax sooner at a lower rate. There's no magic formula for tax efficiency in managing your retirement income. The way we do it is we basically look at different scenarios and different distribution strategies, also taking into account your spending needs, tax situation, risk tolerance, life expectancy, estate planning requirements. It's a nuanced planning situation it's uniquely designed, and it should be just for you and your collection of your piggy banks or your assets that you have. All right, so let's put everything we've learned so far in perspective. Let's review the retirement plan of the Doe family. I think you'll begin to understand the kind of decision-making that needs to go in and will help you get ready for retirement. So we have John and Jane. They're just entering retirement. They have a son and daughter-in-law who they love very much and want to ensure that they leave an inheritance to. They also want to take the time to build memories with their family and help fund their grandson's, Timmy's, college education. John and Jane, they've worked very hard. They've saved diligently through their peak earnings years. They have 401ks through their former employers totaling $361,000. They each have a Roth IRA totaling $253,000, and they have a joint stock account totaling $286,000. They also have been making extra payments to their mortgage at the end of each year and have a current home equity of $325,000. So they have a net worth of a little bit over 1.2 million. John and Jane will receive guaranteed income of $55,226 per year in retirement. They have $73,562 of living expenses per year. And through year 2021, they'll have a mortgage payment of $20,712, totaling $94,274 per year in expenses for the next few years. Now, when we're able to organize your income sources, expenses, and make some base assumptions about your investments, we can analyze your cash flow over your life expectancy. In this case, assumed to be age 95 for John and Jane. As you can see, we project that John and Jane's investments and income sources will support their standard of living through retirement. One of John and Jane's objectives was to leave a legacy for Tim and Cindy. As you can see, under our assumptions, at their passing, there could potentially be an estate of a little over 1.3 million, which is made up of their portfolio assets and home. John and Jane also want to gift funds to their grandchild to help fund his college education and take time to build memories on a few family vacations. So if they gift $5,000 per year in something like a 529 college saving plan and spend $10,000 every other year for the next 10 years to take their entire family on vacations, we can model that they're still projected to have enough portfolio assets to sustain their standard of living through retirement. Because market and financial situations are always changing, you want to note that we've modeled that John and Jane spread out their gifting over a period of 10 years. So that should, their financial situation change, they can scale back on those goals later. You definitely want to review your plan at least once a year. Now, let's take a look at how this gifting has changed the value of John and Jane's estate. When Jane passes, her estate is assumed to have a value approximately of $852,000, which is $505,000 less than before gifting was done. And you'll note that due to the gifting, the majority of John and Jane's liquid assets have been spent by age 95, which would cause a need to downsize or scaling back of living expenses. And that's where an advisor can help. They can help you balance your goals with your financial resources. And in the case of John and Jane, we can help them to balance their desire to be generous with their children and grandchildren and support their own standard of living in retirement. You want to consider what your financial and personal priorities are in retirement and consider working with a professional to determine how best to balance those priorities. Okay, so now that you're filled with all this information and ideas, what should you do next? First, I'd recommend that you get some books or some learning material on the softer side of retirement planning, the ones that talk about what to do with the rest of your life. These books can get you thinking about how you want to design your own life in retirement. Next, you want to get all your papers together, compile all your account statements so you know which assets you have in your accounts, grab your retirement account statements so you'll know what you have there. You want to gather up your credit card statements. You want to put together and just see what you're spending, and maybe you know this already. If you don't, you want to figure out what does it cost, what are my monthly household expenses per month? You want to pull out your latest tax return. It contains a wealth of information that can help with retirement income planning. Gather your insurance policies, health, life, auto, home, long-term care if you have it. And these will help determine the amount of protection you have. You want to find your latest Social Security statement. If you don't have one, you can go to ssa.gov and you're able to generate and download one from there. Finally, pull your estate planning documents, your will, any trusts, if you have one, any advanced directives for healthcare. At the same time you're working on your retirement income plan, you might as well get all of your affairs in order. After all, obviously anything can happen at any time. You want to make a list of questions, concerns, and I'm sure a lot of questions came up during this webinar. Write them down, and as you're focusing on this subject more and more in the days, weeks, months ahead, jot down your questions and make a to-do list. There are a lot of issues in building your retirement income plan, and it takes a lot of hands, yours, your trusted advisors, to create that plan and protect and manage your retirement savings. Some of these areas, like we touched on today, the life planning or visualizing your future in retirement, how you want to live your life, it's very important. Sometimes you may not even have thought about that yourself, yet it's going to affect your next 30 years, 30 plus years. So that's why even talking to a professional, talking to a financial advisor who will ask you a lot of questions can help get you thinking about, what kind of life do you want to lead in retirement. The next, if you need help budgeting, we can help you put, pencil to paper, use an Excel spreadsheet, or even use some automated tools that can help draw up a retirement budget and identify, your different sources of potential retirement income. And then, you obviously, depending upon which of those strategies you take, you may need help with portfolio management. So we offer a variety of investments, financial products, and, we want to recommend ones that work for you. And obviously there's the management of, if you take, for example, that bucket approach or the mandatory discretionary approach, or even that 4% withdrawal approach. It's not a set it and forget it strategy. There is some ongoing management and maintenance that needs to be done. Okay, so, again, thank you for joining us. If you go to our website, we offer a free consultation, which you can schedule from that bautisfinancial.com website. A couple of years ago, I wrote a book specifically on this topic called the Retirement Fitness Challenge, where we'll also provide a link in the webinar replay and the resources section where you can download a free copy of this. We also do have something on our website called the Learning Center, and that links to any of our previous webinar replays as well as our future replays. We have one upcoming called the next one covers the 6 options you have with your 401k when you leave your job. So we'll talk about the pros and cons of each of those options. And Kira, I'll stop there. Do we have any questions?
Thanks, Mark. There's no questions in the Q&A right now.
Great. So thank you everyone again, and look forward to hearing you soon and seeing you on a future webinar.